Good news for Canadians this week as the Bank of Canada holds the key interest rate at 5%. Now, if you saw my video last week, you would have seen that CIBC made predictions that there was going to be a rate increase, but fortunately for many Canadians, that did not happen. So this rate hold follows 2 quarter-point rate increases in June as well as July. And even though we saw inflation increase from June to July, the Bank of Canada said in their press release today that there is recent evidence suggesting that the Canadian economy is weakening and is slowing. And because they made those 2 recent rate increases, they want to see how those impact the Canadian economy before making another increase. We've seen a lot of fast rate increases over the last year and a half, but where rates are today and with the economy and inflation slowing and pulling back, the Bank of Canada needs to be very careful that they don't overshoot their target with their monetary policy. It's often talked about that rate increases can take upwards of 12 to 18 months to see their full effects. So I think it's a good thing that the Bank of Canada is waiting and giving their 2 recent rate increases time to make an impact on the economy before making another decision. That being said, as the Bank of Canada always does when they hold rates, they mentioned that this rate hold does not signify the end of rate increases, and they will continue to increase rents if inflation does not get under control. They have made it very clear since day one they have a target inflation rate of 2%, and they will not stop until that target is hit. Now, there is one really good chart that I want to show you from the CTV news article this week, and it's a really good visual representation of inflation and the Bank of Canada's overnight rate in one visual. So you can see inflation started to go up early 2021. And many say, their target is around 2 to 3%. So they believe the Bank of Canada started increasing rates a little too late when inflation was over 5%. But that being said, you can see that even though the Bank of Canada started to make increases here in February, March, April, May, inflation continued to increase. And that's because there is a delayed impact of rate increases on the Canadian economy and inflation. As rates continued to increase, inflation began to come down and has continued to come down significantly, even though rates have only been going up by small increments. And now that we're getting close to that 2% target, I think it's a smart decision that the Bank of Canada is making small increases and is also having longer pauses or longer rate holds to see the impact of these increases on the Canadian economy and specifically inflation rates. The Bank of Canada also commented saying that we're likely to see inflation hover around this 3% mark for the remainder of the year. And hopefully as we move into next year, we'll start to see it come down closer to that 2% target. Now, as for the impact of this recent rate hold on the real estate market, we likely aren't going to see much change because rates have held and affordability basically remains unchanged for the near future. But because of the time of year, kids are going back to school, people are back from vacation, we typically see an increase in activity as we move into the fall months before the winter. So that's what I would expect to see as we move into September and October. I hope you enjoyed this video. Thanks so much for watching. Have a great day. We'll talk to you soon.